Ladies and gentlemen, Asian Guy here, and after our last video examining whether silver is a good investment in 2026, hundreds of you asked the same question. But how does the silver market actually work? Today I'm going to take you inside the fascinating world of silver market dynamics, and trust me, the reality is more complex and interesting than any conspiracy theory. This is the continuation you've been waiting for, because understanding how silver markets function will change how you think about this metal forever. Let's start with the most important fact that most people completely misunderstand. Silver is not just a precious metal, it's an industrial commodity that happens to be precious. And that dual identity creates market dynamics unlike anything else in the financial world. Here's what makes silver absolutely unique. It's the only asset that's simultaneously a store of value and gets consumed and destroyed in industrial applications. Gold sits in vaults forever. Silver gets turned into solar panels, electronics, medical devices, and literally disappears from the investment market permanently. Think about this mathematical reality. Every year, the world mines about 830 million ounces of silver, but industrial applications consume roughly 600 million ounces. That leaves only 230 million ounces for investment demand globally. When investor interest spikes, that small available supply gets overwhelmed quickly. But here's where the market dynamics get truly fascinating. The silver market operates on multiple levels that most people never see. Level 1 is the mining market. Most silver doesn't come from silver mines. It comes as a byproduct of copper, lead, zinc, and gold mining. This means silver production depends largely on demand for other metals, not silver prices. When copper mining slows down, silver production automatically decreases regardless of silver demand. Level 2 is the refining market. Raw silver from mines needs to be refined into pure forms suitable for industrial use or investment products. This refining capacity is limited and geographically concentrated. Disruptions in refining can create artificial scarcity even when mining production is stable. Level 3 is the fabrication market. Investment silver needs to be turned into coins, bars, and other products investors actually want to buy. This fabrication capacity also has limits, and when investment demand surges, waiting times for popular products can extend for months. Level 4 is the distribution market. Getting silver from refiners to retail buyers requires a complex network of wholesalers, dealers, and logistics systems. Each level adds costs and potential bottlenecks that affect availability and pricing. But here's what makes silver markets particularly volatile. The industrial buyers and investment buyers have completely different demand patterns and price sensitivities. Industrial buyers need silver regardless of price because their production processes depend on it. If Toyota needs silver for automotive electronics, they buy it whether it's $20 or $40 per ounce. Their demand is relatively inelastic. It doesn't change much based on price. Investment buyers are the opposite. When silver prices rise, some investors sell to take profits. When prices fall, some investors buy more to average down. Investment demand is elastic and emotional, creating the volatility that makes silver charts look like roller coasters. This creates a fascinating feedback loop. When investment demand increases silver prices, industrial users start looking for alternatives or ways to use less silver. But most industrial applications can't substitute silver easily because its electrical and antimicrobial properties are unique. The paper markets add another layer of complexity that most people don't understand. The COMEX futures market allows trading of silver contracts that represent 5,000 ounces each. But here's the crucial point. Most futures traders never want to take delivery of actual silver. They're just betting on price direction. This creates a massive multiplier effect. The paper market can trade the equivalent of annual global silver production in a single day, even though that much physical silver doesn't exist or change hands. When paper traders all bet the same direction, it can move silver prices dramatically without any change in physical supply or demand. The ETF market adds yet another layer. Funds like SLV allow investors to buy silver exposure without handling physical metal. But when ETF buying surges, fund managers need to purchase physical silver to back the new shares. This creates sudden spikes in physical demand that can overwhelm supply chains. Here's where market structure becomes critical to understand. The silver market has periods of normal operation and periods of stress when the usual relationships break down. During normal periods, arbitrage keeps different silver markets roughly in line. If COMEX silver trades higher than London silver, traders buy London and sell COMEX until prices converge. This arbitrage mechanism keeps global silver prices coordinated. But during stress periods, arbitrage breaks down. Transportation delays, financing costs, or political restrictions can prevent traders from moving silver between markets. When this happens, silver can trade at different prices in different locations, sometimes with gaps of $10 plus per ounce. The dealer market reveals another crucial dynamic most investors never see. Coin and bullion dealers operate with relatively thin margins and limited storage capacity. When investment demand surges, dealers can't instantly increase inventory. They raise premiums to slow demand while they wait for new supply. This creates the phenomenon where spot silver might be flat, while retail silver prices rise dramatically. The premium isn't dealer greed, it's supply and demand economics at the retail level operating independently from wholesale markets. The international flows add geopolitical complexity. Silver production is concentrated in a few countries: Mexico, Peru, China, Chile, but consumption is global. Trade restrictions, currency changes, or shipping disruptions can create regional shortages even when global supply is adequate. China's role deserves special attention because they're both a major producer and major consumer. Chinese policy changes can affect global silver markets immediately. Export restrictions can reduce global supply. Import increases can boost global demand. Most importantly, China's domestic market is large enough to absorb significant silver quantities without international trade. The recycling market provides another supply source that most people ignore. Silver from old electronics, jewelry, and industrial applications gets recycled back into the market. But recycling economics depend on silver prices, labor costs, and environmental regulations. Higher silver prices encourage more recycling, which increases supply and moderates price increases. Here's a critical insight about silver market cycles. They're driven by the intersection of slow-moving structural trends and fast-moving financial events. Structural trends include industrial demand growth, mining production changes, and recycling rate evolution. These trends develop over years and create the underlying supply-demand balance. Financial events include investment fund flows, currency crises, and geopolitical tensions. These events can cause dramatic short-term price movements that may or may not align with structural fundamentals. Understanding this distinction helps explain why silver can have explosive price moves followed by long periods of sideways trading. Financial events create the volatility, but structural trends determine whether higher prices are sustainable. The regulation of silver markets varies significantly by country and market segment. In the US, the CFTC regulates futures markets. The SEC regulates ETFs. But physical silver trading has minimal regulation, creating arbitrage opportunities and potential manipulation risks. Position limits in futures markets are designed to prevent any single trader from accumulating excessive influence. But these limits apply only to regulated exchanges, not physical markets or international trading. Market surveillance systems monitor for unusual trading patterns that might indicate manipulation. But determining legitimate price discovery from improper influence requires sophisticated analysis that regulators may not always perform effectively. The taxation of silver varies dramatically by jurisdiction and holding method. These tax differences affect arbitrage opportunities and investment economics. Storage considerations create another market dynamic. Physical silver is heavy and bulky compared to gold, creating natural limits on accumulation and proportionally higher storage costs. Technology developments constantly change silver's demand profile. New applications like 5G infrastructure increase usage, but new manufacturing techniques might reduce consumption per unit. Here's what every market participant needs to understand. Silver market structure creates inherent volatility that can't be eliminated. Silver will always be more volatile than bonds, more complex than stocks, and more unpredictable than many expect. This volatility exists because silver serves multiple conflicting roles. Industrial users want stable supply. Investors want appreciation. Miners want profitability. These different goals create tensions, driving market dynamics. Understanding market mechanics matters more than predicting direction. Markets can remain irrational longer than investors can remain solvent. But understanding irrationality helps with positioning and emotional management. Silver markets operate on multiple time frames simultaneously. Day traders focus on technical patterns. Industrial buyers focus on supply security. Long-term investors focus on structural trends over years. Successful participation requires matching strategy to time frame and understanding which forces dominate during different periods. Supply disruptions favor physical dynamics. Financial crises favor investment flows. Normal periods favor industrial fundamentals.
This is Asian Guy,
And understanding silver market dynamics isn't about predicting the future. It's about understanding present complexity driving price behavior. The market surprises everyone occasionally, but understanding mechanics helps separate signal from noise. Whether you participate or not, understanding these markets provides insights into commodity markets, supply chains, and the intersection between financial assets and physical resources increasingly shaping our global economy.